with us Mr. Viren Shetty, our Vice Chairman, Dr. Emmanuel Rupert, our CEO and MD, Ms. Sandhya, our CFO, Mr. Venkatesh, COO of our Eastern and Southern Domestic Operations, Dr. Anish Shetty, MD of our Overseas Subsidiary HCCI, and Durga Prasad from the team. I'm sure you have gone through the investor collaterals which have been uploaded on the stock exchanges as well as on our website. As usual, before we proceed with this call, I would like to remind everyone that the call is being recorded and the transcript of the same shall be made available on our website as well as on the stock exchange at a later date. I would also like to remind you that everything that is being said on this call that reflects any outlook for the future or which can be construed as a forward-looking statement must be viewed in conjunction with the uncertainties and the risks that they face. These uncertainties and risks are included, but not are not limited to what we have already mentioned in our prospectus filed with SEBI before our initial public offer in late 2015 and subsequent annual reports on our website. Post the call, should you have any further query, please do not hesitate to get in touch with us. We would like to address it to the best of our ability. With that now, I would like to hand over the call to Dr. Rupert.
Good afternoon to everyone. I cordially welcome you all to the Q2 FY23 Earnings Call conference of Narayana Hrudayalaya Limited. The second quarter of fiscal year exhibited robust performance and maintained the momentum set by the first quarter due to an improvement in patient footfalls, case mix, and payer mix. Consolidated revenue for the current quarter stood at INR 11,416 million, a quarter-on-quarter growth of 21.4%, aided by steady performance of India business and strong performance of Cayman business. NHL generated consolidated EBITDA of 2,749 million in Q2 FY23 at a margin of 24.1%, which, when adjusted for one-time other income, stood at 22.3% as against a margin of 19.4% in Q1 FY23. This margin improvement was attributed to improving volumes, payer mix, and procedure mix. Our Cayman business demonstrated continued growth due to lifting of restrictions, and HCCI Cayman revenue increased by 28% to $29.1 million. Our overall balance sheet and liquidity profile remains strong, with INR 7.2 billion of gross borrowings against a consolidated cash and liquid investments of over INR 4.6 billion as of 30th September 2022. Our debt to equity ratio remains comfortably low at 0.14, giving us room to fund our expansion through borrowing and internal accruals. Including our recent acquisition at Bangalore, we have incurred capital outlay of close to INR 5.5 billion for the 6 months ending 30th September 2022. We will continue to invest as per our strategic priorities, and we believe that our capex should be north of INR 10 billion in FY24 as well. What gives us immense pride is bringing access to advanced quaternary care to patients from all sectors of society. In line with our vision to continue to invest in state-of-the-art medical equipment, our unit in Howrah commissioned the latest model of linear accelerator, which is the Varian True Beam in Q2 FY23. We have witnessed strong momentum in high-end cardiac sciences work in both congenital and adult segments, and also in oncology work in robotic procedures, and also in the fields of transplantation, which is both solid organs as well as bone marrow transplants. We are proud to share that Narayana Institute of Cardiac Sciences in Health City, Bangalore, has consistently performed more than 750 cardiac surgeries since March of 2023, and did this highest ever procedures in the cath lab of more than 1900 procedures. The unit was also successfully conducted more than 28 percutaneous valve implantations of the aortic valve in this quarter. Majumdar Shah Hospital in Health City, Bangalore, also successfully performed more than 74 robotic procedures for very complex oncology procedures. it's very heartening for me to share with you that we have been able to perform 2,000 bone marrow transplants across our network hospitals over the last 15 years. We are increasing our investments in digital engagement channels to improve operational efficiencies and patient experience. The digital traffic grew by 49% to 2.75 million users in the current quarter as against Q1 FY23. As India's leading cardiac and oncology provider, we have been able to meaningfully contribute to cutting-edge medical research. We have already published more than 192 scientific papers in this current year. And for the last 2 decades, we have published close to 1,800 scientific papers. One of the interesting research activities that is currently undergoing, along with the University of Arizona, is a multimodal intraoral imaging, which is used for early detection of oral cancers, which is used with a smartphone and a specialized app that comes along with that. Another cutting-edge research is in the field of the bone marrow transplants, which we do one of the highest number of bone marrow transplants in the country, is a special drug which needs to be used for what is called as the complications of that, called as the graft versus host disease, which is basically a rejection of the transplantation cells. We have previously spoken about our collaboration with Immunil, which is a Biocon startup. It is a GMP certified processing center, which is in-house in the Health City campus for making what is called as the CAR-T therapy. CAR-T stands for chimerase antigen receptor. These are nothing but receptor proteins that are present on the cells, on the T cells, and they are re-engineered in the GMP certified process. The blood is removed from through an apheresis machine, and this separates out the T cells from the patient. And it is re-engineered by injecting a gene for chimerase antigen receptors, and then we grow millions of these CAR-T cells in the artificial lab. And it is reinfused into the patient, and you have a specific targeted destruction of the cancer cells. This is a major new dimension of therapy for refractory cancers across the world, which costs up to $500,000 to $1 million cost across in the Western world. And we are participating in the trial with Immunil, and following the regulatory approvals, which will take some time, we should be in a position to be able to provide this form of therapy to many patients in the Health City campus. Our Health for All is our guiding beacon, and it has always been an integral part of everything that we do. We are proud to have contributed to discounts, subsidies of greater than INR 300 million towards providing subsidized or free treatment for indigent patients in H1 FY23. Our CSR team continues to focus on providing scholarships for underprivileged children to pursue medical education. While the results do bear about our focus on execution, as articulated, we are looking to also pursue strategic growth opportunities as reflected in recent acquisitions across our flagship region as well as Cayman Islands. We remain confident about the demand for healthcare and our ability to deliver high-quality solutions to all sections of society. Thank you.
I would request everyone to now use the raise hands feature to start posing their questions, and we would try to address it out here in this forum. Any questions from anyone? Yeah, Dhiresh, you can go ahead with your question.
Yeah, I need a few details. So what was the EBITDA in the Cayman Hospital asset for the quarter?
It was, I think, $12.7 million.
Okay, this is this post Ind AS, right? What was it pre?
Yeah, post Ind AS.
And what is the adjustment needed for between post to pre?
For Cayman?
Yes.
Cayman, I think it's 0.5 million. So
0.5
pre-index is 12.2.
Okay, understood. For the year, 1,000 crore capex, I think about 100 million is in Cayman. Is that entirely? So maybe what would be good for me is if you can break this 1,000 crore capex, at least for FY23, into which projects it is going into.
So out of this, Dhiresh, we have already incurred around 300 odd crores towards our complete acquisition, including the primary investment or subscription of the OCD that we have done over there. Alongside that, while we had initially expected capex outlay of more than $60 odd million for Cayman, but given the run rate and some supply chain issues, we now foresee that number to be hovering a little shy of $40 million. So around $30 million of capex is possibly pending in over the H2 period in Cayman itself. Other than these, all the capexes that you would see would be routine maintenance, upgradation, and our brownfield expansions that we are incurring at multiple locations of ours.
Okay, so just to summarize, 300 in the acquisition that you did, and $30 to $40 million for the full year in Cayman, and balance on maintenance and debottlenecking, right?
Yeah, and additionally
that,
additionally that $5 million of upfront consideration that we need to pay for that acquisition that we have announced at Cayman also recently. And that the transaction is pending to be closed as yet.
Okay, and in 24 you will do the balance $60 million of Cayman, and you also said that 1,000 crore capex we'll have in FY24 as well. So what would be the balance in 24? Like what I want to understand is, in Indian assets, is there meaningful capex? Because we talked about in the last few calls in terms of the legacy flagship locations of Bangalore and Calcutta wanting to expand more there. So I just want to know, if you can give some more details in terms of how much capex you're doing in those two locations.
Viren, you would want to elaborate on that? The other than the normal maintenance and the the Cayman thing which we have already elaborated, or brownfield capex, anything else?
Yeah, it's more of the same as we described. In Bangalore, we'll be adding additional infrastructure to the health city, an expansion to the heart hospital, one in partnership with the landlord, one will be doing greenfield. Calcutta, we are looking to acquire some land and add new infrastructure close to our existing hospital. These are all work in progress. We budgeted about 1,000 crore, which includes work in progress as well as some expansion works. But in the time it takes for us to finalize contractors and start doing this work, we will also start including additions. So conservatively, we can say about 1,000 crore by 24 also. And these projects are 2 to 3 year duration builds. So it gets spread out over that amount of time. The exact details, we'll start detailing it out from the next quarter onwards. But for now, it's looking like there will be significant capex investment in Bangalore and Calcutta.
Okay. Last question from my side on the three assets which earlier we used to disclose separately, the revenue and the EBITDA. So SRCC, Dharamshila and Gurgaon. You can just highlight either individually or collectively what has been the EBITDA and revenue in those assets.
So this is Sandhya here. The three hospitals have every quarter it's like highest ever revenues we have to say. We've done 1078 million in Q2, were compared to 942 million in the previous year. So it's a 14% YOY growth. We have registered a positive EBITDA margin of about 8.3% put together. Dharamshila has broken even. Gurugram has almost broken even. Mumbai is on the verge of break even. So all of them are going in a very positive direction.
Okay, so when you say breaking even, this would be after the rental and after the various other cost overheads. This would be like at the EBITDA level for the asset, because EBITDA you are showing positive, right? 8.3.
Exactly, you're correct. Broken even at the EBITDA level as well as the cash flow level.
Okay. Great. All right. Thank you.
Thank you.
Thanks, Girish. Anyone else with any other question? Yeah, Dhara, you can go ahead. Dhara, I guess you need to unmute yourself.
Yeah, sorry. So I had a question regarding the CAR-T therapy which you were talking about with Amneal Pharma. So I understand currently there are only few drugs like Kimbria and Yescarta from BMY and Gilead, which are there in the market. So what exactly were you talking about the Amneal Pharma, because that's a generic company, right?
No, it is. It's a new. GMP production facility housed within the Health City campus. It is still in a trial phase. We need to give the results of the detailed trials to the regulatory authorities before any kind of a commercialization of this entire thing will be taking place. And currently, there is no other GMP certified CAR-T therapy production center in India, which is made in India. Even if something is being done, they are procuring it which is processed by some labs outside of the country.
Okay. So another question was like, when can we expect our Ahmedabad and Mumbai cluster to deliver positive EBITDA margin? Like the one we have seen in Gurgaon, no? 1 year back it was around negative EBITDA, and now currently it's contributing 12%. So can we see some improvement for this cluster, Ahmedabad and Mumbai to be particular?
Sure. Ahmedabad is already cash and EBITDA positive. Mumbai has almost turned around. In H1, it was a negative of about 3.3 crores. So Mumbai is almost turned around. I think another 6 months to 9 months, we should be able to see a break-even EBITDA in Mumbai, and we'll be able to build from there.
Okay, got it. That's it.
Thanks, Dhara. Ashish, you can go ahead with your question.
Thank you. Congratulations for a good set of numbers. Just wanted to try and understand that we are doing a 2,000 crore capex over this year and next year, and what would it imply in terms of the balance sheet and return ratios? So currently we have 300 odd crores of debt. So what's our estimate of the peak debt for the company, let's say, over the next couple of years?
So, like you're aware, we are cautious in terms of borrowing. So we would like to, our desired level of debt EBITDA is that debt equity is less than 1 or around 1. That is the desired level. Debt EBITDA maybe for a short period may go to 2.5 and then come back, 2.5, 3 and then come back. Having said that, we are hyper focused on cash flows. You would have seen that there is a tremendous amount of cash outflow that has happened in the current quarter, but that kind of borrowing has not happened because we've been very tight on our cash management. So we would like to see as much as possible that we can fund our expansion from our internal accruals, and that we have to borrow only as much as required. So we will aspire to keep our borrowings at that level.
Sandhya, sorry for I didn't get the numbers right, because our EBITDA run rate is roughly 1,000 crore run rate, and our equity is also, if I remember right, around 1,800-1,900 crores. So what you are saying is that you are talking about a two times debt to EBITDA, or 2.5 times, which means a peak debt of 2,500 crores, as compared to less than 300 crores today net debt, right?
Yes.
So we are saying that we are going to borrow 1,800 crores more in an environment of rising interest rates. Is that what we are looking at? Because when I look at it from a 6-quarter perspective, based on the cash flows, we should be generating at least 1,000 crores of cash flows, and our capex is around 1,700 crores, which means they don't seem to tie to from my perspective.
Currently, our borrowing is about 750 crores.
I'm looking at the net debt number, Sandhya, because that's what's relevant.
I understand. Net debt is a matter of the cash flows that we are retaining and the cash flows that we are investing. So the way we've looked at it, I'm giving a gross number because that's a better representative. Right now, our borrowing is at 750 crores. Our equity may be currently 1,800 crores. So we do want to keep our debt equity at less than 1. So even though we would be incurring, say, more than 1,000 crores of capex, we don't want to keep the debt equity at that level. That's a desire or where we want to be. So some of it would come from this cash flow. That's why you're seeing the benefit in the net debt, because there are accruals that we will use. And some of it will come from better management of cash on the ongoing basis. As far as debt by EBITDA is concerned, what I gave you was an outer limit, because this is a cap that we want to work with over the next 2 to 3 years. And depending on how our cash flows and EBITDA turns out. So that's an outer limit. I think these numbers give you enough guidance on where we are headed.
Sure. The second question on the cash flow again, because my understanding is the reason why we had a large cash balance was because money had got trapped in Cayman and there would have been a tax incidence. Now that we are doing a large capex in Cayman, hopefully our cash balances, which are running at 400 crores, would kind of come down. Where I'm coming from is if I put in a 2,000 crore debt number and I project the numbers forward, our ROCs will fall significantly from where we are seeing today. It is in the short term before these new projects start churning around ROCs. And
Ashish, you're right. I mean, the short term, but we can't sit on the existing capacity forever. So we have to grow. We have to.
No, absolutely, Dividend. No, I'm completely with you in terms of the growth. When we ran our numbers, we were looking at a peak net debt of less than 1,000 crore, even assuming 1,000 crore capex. So the question is, if we are saying that instead of 1,000 it's going to be 2,000, so is there a larger capex that is kind of missing in the whole, which might not be frozen, but is something which is something which you are thinking about?
Yeah, it's a guidance was thinking, and it's all tied to construction. It's anyway spread out over a duration, can be extended, can be reduced, can take a call on how we spread this out to match the cash flows and to keep our debt within manageable levels.
Debanki, just a data point, how much is the cash which is trapped in Cayman as of today?
I have to confirm that to you separately, Ashish.
Sure.
I don't recollect that offhand.
Okay.
We have about $30 million of cash, and then we also have mutual fund investment. I just want to clarify that I don't know if it is right to say that cash is stuck in Cayman. We can always bring it back. We just have to pay tax and bring it back.
That's what I meant, Sandhya, but there's a tax incidence.
Yeah, every income has a tax incidence. So that is a decision we will take. If we need the cash, we will bring the cash. It's not locked there. So I just want us to.
Sure. No. I think, Sandhya, the fact is that you are doing a large capex, so you might as well use the cash. Why do you pay an extra dividend tax?
Yeah, which we intend to do, yes. We intend to use for our capex, and if there is need in India, we will bring back Cayman cash.
Okay. Thanks a lot.
Yeah. Anyone else? Any question? Yeah, Dhiresh, you want to ask any follow-up question?
Yes, I do. So given that
it's
kind of, the opportunity is there, I might as well ask a few more questions.
Please go ahead.
So I'm just trying to better understand the capex that we've outlined for Cayman. So if I understand correctly, it is, and please correct me if understanding is wrong, so $100 million for a 50-bed asset. And then there are a few clinics and other things, right, that we want to do. Given, I'm just trying to understand like how much, what is the revenue potential of this capex that we have in mind, because this is not just going into hospitals, might go into a few other clinics and other off hospital kind of assets as well. So what kind of an asset turn and margin profile do we have in mind at maturity for this incremental $100 million?
Anesh, you want to take this?
Yeah, sure. So just for clarity, the $100 million will be invested as we previously outlined over a period of 2 years. some of which will be incurred in the current year, and the balance, it's about 40 million or so we project to incur in the current year, and the balance in the next year. As you rightly said, most of it will be towards a single cancer-focused hospital with an attached radiotherapy block. The hospital will be commissioned in 2 phases. The first phase is the radiotherapy facility, which we hope to commission in the 4th quarter of this year. So that's within the Jan to March of 2023. So that's a standalone radiotherapy block, which is part of this facility and part of the capex number you mentioned. That will start treating patients immediately, which is Jan to March of 2023. Thereafter, we hope to commission the rest of the hospital, which will have the inpatient facility, the operating rooms, and the other ancillary services with the cath lab and things like that. Over the next, I think we had earlier mentioned 12 months subsequent to that commissioning of the radiotherapy facility. In terms of margin expectation, in the short run, obviously, because the hospital will have an initial ramp-up period, it's not going to be anything in several years what we saw when we first entered Cayman, because this is now a known market to us. There will be some amount of dilution of margin simply because there will be some amount of business shifting from the existing facility to 2 facilities. But in the long run, we absolutely intend this facility to be, on the whole, our margin should not be diluted to where they are currently. So we currently are in the range of 40 to 45%, and that is our long-term target as well, to preserve that, of course, on a much larger base, given both the hospitals and given the dedicated cancer focus, which is an offering we currently do not offer.
Okay, so this is very useful, but given that it's a cancer hospital, and even otherwise you've told us not to look at ARPOB and bed occupancy and all that, right? Because that might not be a right metric, especially it's a cancer hospital. There's a lot of it would be daycare procedures as well. So what is also important, apart from the margin number that you share, to understand the revenue potential that the whatever cancer block that you're putting, the radio block, as well as the balance other assets that you're putting, how much revenue potential? Because the current asset, I think if it is properly utilized, is generating about $120 million annualized. So will this $100 million have similar potential, or will have much higher potential of the absolute revenue that it can generate at stability?
Sure, Dinesh. So you are right about, approximately in the ballpark of the current asset, give or take plus or minus $10 million here and there. We have refrained from committing on an exact revenue guidance number for the new hospital. But what I can share is, from a margin perspective, after the initial ramp-up period, we do not expect it to dilute our existing margins.
Okay. Thank you so much.
Thanks, Dinesh. Ashish, you have any follow-up question?
No, I just...
Okay. Anybody else? Any question, guys? Yeah, Kapil, you can go ahead.
Yes. Congrats on a robust performance, as Dr. Rupert mentioned. Can you give us some broad indication on whether this robust performance has continued till date?
Okay. As you are aware, Q3 is normally a seasonally weak quarter. In the month of October, there were there was Diwali, there was also the Durga Puja stroke Dashara across the country. So there will be some moderation that will happen, like it happens in every year in Q3 in the numbers. And we have seen that moderation happening through in October numbers. But I think some of the underlying work that we have done, which has created the traction that we have achieved, those are here to stay. And therefore, to that extent, I think the momentum you will be able to see. But Q3 is normally a weak quarter in general for healthcare.
I see. I understand. Thanks.
Ahmed, you can go ahead with your question.
Wanted to understand a little better on our matured hospitals, or rather our flagship hospitals in Bangalore and Kolkata. So even if I see from Q1 to Q2, there is some margin expansion. So from here on, from the current base, is there further scope for volume expansion and margin expansion in those hospitals?
Volume expansion may not be much because the buildings are quite full. The margin expansion would come through a lot of the efficiency work that we are doing, reducing length of stay, changing the payer profile of the patients, focusing on higher end surgeries. But those don't happen it won't swing that much over each individual quarter. So for example, as Sandhya mentioned, that this quarter now, because we have less patients coming from East because of Durga Puja, less patients coming from for checkups because of the Diwali. There will be some moderation there, but it picks up after that. In December time, again, it starts to pick up. But ultimately, for these, the next level of growth will ultimately only be driven by addition of capacity. There's only so much tweaking that can be done that will give these single-digit increments here and there. If we're looking at the big numbers, we'd have to do full-scale capacity expansion, which is what our plans have taken into account for the next 2-3 years.
Got it. Thank you.
Yeah, Prashant, you can go ahead with your question.
Yeah, good afternoon. Thanks for the opportunity. I have two questions. So firstly, can you give us a sense of where we are now if you compare to pre-COVID levels? Where are we now on outpatient flow and on international patients?
So on international patients, we are above around 7.5%. We have already given commentary earlier saying there have been changes in the way we have our business model for international patients is, and therefore recovering back to the pre-COVID levels. We will have to see how it goes. I think we have reaching a good improvement quarter on quarter in our international patient volumes. Now, as far as the IP/OP is concerned, I think we have largely returned to our pre-COVID volumes. In fact, we have been able to exceed them as well.
Yeah, thanks. And my second question is on, so in earlier calls, you have mentioned that you would be looking at opportunities outside India, other than Cayman. If you could just elaborate, what form these could take in terms of, capital deployment, what kind of assets you're looking for, that will be useful.
Anish, you want to talk about the other Caribbean things?
Sure. So we've been in the Caribbean region for about close to 8 to 10 years now. And through this time, aside from Cayman, we've naturally developed an interest in the other islands to look for a similar market elsewhere. For the past 2 years, we have been engaged with the government of St. Lucia for a management contract for an asset for them that has recently concluded. It is challenging to find another market like Cayman in terms of revenue potential, stability, geopolitical risk, and other associated factors. So our choice, our preferred method of expansion outside Cayman will be initially in an exploratory fashion, then maybe in a consultancy fashion, and then followed by a very, very capital light model, if at all we do get there. In the foreseeable future, it is we do not have any clear visibility on deploying anything in the range of $50+ million or large sums of money outside Cayman for now. And we have already, we already have a significant amount of outlay within Cayman itself. Having said that, there are multiple early opportunities that we are pursuing, but these will have a long gestation period for us to learn more about the market, to develop the relationships, and have the confidence to essentially, pull the trigger over there.
Yeah, thanks a lot. That's it from me.
Thanks, Prashant. Gagan, you can go ahead with your question, I guess.
Yeah. Thanks for taking my question. And apologies if this is a repetition. There was another call to join. So the first one is on gross margins. Your gross margins for the quarter and for the first half are up by a reasonable amount. Is that sustainable, and what is behind it?
Okay, so a lot of the improvement in gross margin after you eliminate the one-timer we spoke about is coming from underlying improvement in the cost structures. We've also got a favorable impact of the mix which is playing there. So from what we've done in terms of sustaining this level of costs from an efficiency point of view, I think it is sustainable. But what I want to definitely call out is that the cost situation is exceptionally volatile for us. One is currency is playing a big role in terms of both medical imports as well as biomedical equipment. So that is one aspect which is playing out. The second also is the supply chain has been, the stability in the supply chain has not been achieved at all. So there is tremendous disruption that we are seeing in the supply chain in terms of various input material. And so while we are holding on to what best we can do in terms of cost and efficiency, the situation is a little volatile for us. And I think it's true for all other healthcare organizations as well. So it's a little difficult to give a very strong forecast that yes, these cost levels we can maintain. These efficiency levels, yes, I think we can maintain.
Right. And your cash flow from operations is also jumped significantly. There's release of working capital. Can you elaborate a bit on that? And from a net working capital day standpoint, what we've seen for the first half, while your cash flow, is that representative of a sustainable future?
Yeah, okay. So one is that we've been, like I had mentioned earlier in our commentary, we've been hyper-focused on being able to manage our investments within our cash flows. But I think one of the reasons why we had the release of working capital is because we were able to improve on some of the collections from the government payers. So a lot of the backlog that had got accumulated with some of the government payers got released in the current quarter, and that helped us with cash flows and working capital. But like it is with every government payer, it is depending on when the government releases funds to them, that's when they pay us. So the underlying operating cash flow is sustainable. The timing of some of the government collections coming exactly as on 31st December and therefore being able to maintain the same number on 31st December, that is a little difficult to forecast.
Right. And on the India part, for your CapEx program of, I think you total is around 2,000 crores, 800 goes to Cayman. Can you just explain, what's the part of CapEx that comes in this year, what comes in next year, and how does it commission, over what time frame does it commission, and or what time frame do you see that getting utilized optimally?
So like we had explained earlier, about north of 1,000 crores is what we think we will spend this year, of which about 300 crores was the Sparsh asset itself. And then the rest of it, and Cayman expansions about upwards of $30 million. The rest of it is on both brownfield replacement, maintenance, capacity expansion, etc. Next year also, I think Cayman will be about $60 million, and then we would have the expansion. Like Viren explained, we would like to do expansion within Health City, as well as we have expansion goals in Calcutta. These are all construction linked. So while we are saying we will spend that money, it depends on how we do the project and build up and availability of input material and stuff like that. So we believe that including Cayman, we'll spend upwards of 1,000 crores over next year. Construction will go, some of the greenfield construction will go into FY25 also.
Assume an even distribution over this duration, because equipment ordering and all of these long dated things will be matched to cash flows and the requirement on site.
So when do you see the new greenfield assets coming on board operationally for you?
It will be around 30 months plus. New construction takes about 24 months. Add another 6 months to commission and any kind of contingency.
Right. And in the interim, with addition of machinery, on your existing assets in Kolkata and Bangalore, what sort of ramp up is possible from the same hospitals?
There is some minor work that is going on room refurbishment, adding one extra OT in the heart hospital, Calcutta, adding a few OPD rooms. So those things are marginal at best. They will have a minor contribution, but it's not. It won't swing the needle too much.
Yeah, just to add, there is expansion work happening in the specialities across. So we are setting up, for example, oncology capability in many of our hospitals, the key hospitals. So there will be, so some of the routine capex which we are talking about is not just, room addition, but also specialty capability addition. So that will give us the volume uplift and flow through, even though we may not be increasing the number of beds.
Okay. So on the India assets, would it then be reasonable to assume that the first half margin trajectory can only get a little better? I mean, I understand you talked of some volatility in your gross COGS line, but ceteris paribus, should margin improve at least for the India piece? I understand Cayman new assets come in and there's a period where they consolidate before you sort of come back to your optimal margin. And I'm talking about India till the time the new assets come in.
You can assume that, subject to, of course, what we had said, saying there is a lot of volatility on the cost side, which we are not able to forecast at the moment.
Yeah, that's an important disclaimer you added there. All things being the same. Things that we project could happen. One is obviously the macroeconomic situation, interest rates, things we cannot control, government receivables stretching beyond any kind of margin capping, adding more drugs to the price control list, salaries going up by quite a bit. There is a huge amount of demand, for example, for nurses and doctors in the US and Canada. And usually when that happens, a lot of senior nurses and doctors tend to leave the Indian system, and we need to pay a lot higher to either retain or to get more people there. So, but these are part and parcel of any business, and ours is a business that does have as many external shocks as the others. But the thing that we're working toward, that we would strive for, is to deliver a sustainable growth, to be able to increase our utilization, to be able to treat more patients and go into very high-end surgeries, and that we'll continue to drive. And if it so happens that these things have an impact, the impact will be there, it will be limited, and we'll be able to find a way to get around it in the next quarter or after.
And finally, I mean, what's the headroom for improving, your ALOS and RPOB? I mean, I think last call you did indicate that the aspiration is to take ALOS, to and take it to the level where it's benchmarked to your peers over a period of 2 to 3 years, if I recall it correctly. Do you stand by that? You feel in the coming 2-3 years you have room to reduce ALOS, and with your case mix, what should be a possible trajectory for your RPOB?
There will be only a marginal improvement because we will be mainly working on efficiencies in reducing the ALOS and working towards the kind of procedures that can be moved and a lot of things changing in the way the clinical pathways can be worked on. And that is something which we're working with the clinical teams, and we're working in tandem with them to get this done. And we will be seeing on a quarter-on-quarter marginal improvements, and we will, whatever guidance we had given in the last earnings call, I think that should be achievable.
We are working towards RPOB improvements, but the fact is ours is a brand that's more targeting the affordable class, and our room configuration and our payer mix is skewed more towards middle and low middle class. So we will always be at a RPOB disadvantage compared to our peers. But how we seek to improve the gap is through the efficiencies, addressing the air loss, increasing the throughput utilization, which will get there. But we are looking at changing the payer mix. We are, like we said, in the capacity expansion, all the investments we're making on our infrastructure, adding new service lines, adding new capacity to Bangalore and Calcutta is built at addressing a lot of those structural differences that exist between our hospitals and the rest. But it will take time.
And for the asset that you acquired, if you could give us some idea of both, from an operational standpoint, from a business mix standpoint, and from key financial numbers on that one, and how do you and what are your plans for that?
This is the Bangalore acquisition?
Yes.
So this is an orthopedic only hospital that is adjacent to our Bangalore Health City. Under the terms of the agreement, they would only do orthopedics and we would do everything but orthopedics. So the biggest advantage this brought to us was that it unlocked the ability to do orthopedic procedures. This will be added on to our Mazumdar shop numbers. So because the unit by itself, we didn't want to report it independently because it's not as big as the Mazumdar shop, and it would integrate very closely with that. So that will operate as a specialty. The building itself is about 140 bed infrastructure. It can go up at another 100 beds over there, but that we won't be taking it up right now. We'll be taking it up in time. But essentially, this is something that was an add-on. It immediately decongests a lot of the beds that we need. It immediately adds more capacity for us, which can be used in the run-of-the-mill business. But over time, because of the additional orthopedics, we'll add a new service line to our Bangalore numbers, and orthopedics in most hospitals is the second or third largest department for them. So to give us that platform to be able to build and grow this as well.
How much capacity does it release for you if you shift the entire orthopedic payload to this one, the one that you are handling right now, when you transfer it to Sparsh?
I mean, in theory, 140, but that's not practically how it's going to work out, because you'll have to build up the specialty from ground up. When we acquired it, we have to get the new doctors, we have to equip it, get all the latest equipment, get a new clinical team, because we acquired this from an existing Bangalore orthopedic group. And so it didn't come with any doctors, and the patients also left with the business. For us, we'll be taking it because of its strategic proximity to our health city and allow us to build that up. So over time, it would get full very quickly and will get expanded. But for right now, it was more about adding orthopedic and the trauma specialty to all our offerings.
And how does the margin profile or ALOS and ARPOB for this one compare to your metrics?
So Sparsh was last year they had done about 49 crores of revenue, but that was COVID impacted. If you analyze the period that Sparsh was with for this year before we acquired, that will be about 55 crores of revenue. They were having a margin profile upward of 20%. I think we will be able to maintain their margin profile. I also think we will be able to reach the revenue thresholds, in fact, grow from where Sparsh was. ALOS, in the overall, MS, because this will be part of MSMC, in the overall volumes that MSMC does, what comes from Sparsh, I don't think it will significantly move the ALOS number for MSMC or for Health City.
Thanks. That's all from my side. Thanks for taking the questions.
Thanks.
Thanks, Gagan. Dhiresh, you have any other follow-up question?
Yes. Given the opportunity, I might just make the use of it. One bookkeeping, this Cayman asset in the preceding quarter, the June quarter for this year, was how much EBITDA? If you have it handy, otherwise I can take
8 million on 22.7 million revenue.
Yeah.
Okay, for Q1 FY23. This for the the three assets that we were disclosing earlier. So SRCC, I'm aware because I think you had explained in the last call the reasons for lower delay in the maturity timeline. For Gurgaon as well as Dharamshila, now if I look at the way you have disclosed the Western block numbers, it seems So sorry, before I go there, so maybe for Gurgaon and for Dharamshila, like what, because if I understand correctly, they were started in FY18 and it's been a few years. So I would have expected them to have, reasonably good, margin profile by now. So is there a specific reason for each of those assets and why they've been delayed? Like you explained for SRCC, can you explain for these two assets also, like why they have been slow to ramp up to maturity?
Yeah, one of the reasons is Dharamshila was heavily focused on only the onco specialties, and we were trying to grow completely new specialties into that. The growth has happened in steps and stages and other things, but for more than 2.5 decades, they were known only as a cancer hospital. So we started off at a disadvantage, but we are reaching there, and the growth we will see in all the specialties, including the oncology, will bring us into the next phase of the growth for Dharamshila. As far as the Gurugram hospital is concerned, it's a smaller facility compared to many of the other major facilities which are present in Gurugram. And it is a little smaller facility, so we are picking and choosing the specialties that will fit into this profile and the kind of the ALOS and the mix that needs to be there, and then we're trying to sort that out.
How many bed hospital is Gurugram?
Sorry, go ahead. Could you say that again?
Yeah, so I'm saying you said it's a smaller facility. How many bed hospital is it?
Gurugram, we have 225 with a census bed of around 175.
So it's not that small. So there must be some other reason, I'm sure, for the delay in the maturity profile.
Yes. Yeah. So if you talk about all the reasons, one is we were a completely new brand coming into Delhi, and Delhi is not exactly a virgin market. And Gurugram especially is one of the most competitive markets for healthcare in the whole country. We came in with cancer focused, yes, but a little bit niche in that it was a little smaller compared to, let's say, Medanta, Artemis, or FMRI. We had a very different set of clinical mix. We didn't have too many superstar doctors. We had one or two, but we didn't have the best of breed consultants that we were going up against. Our hospital was not very strategically located compared to the others. So there were a lot of lessons that we learned. It's not to say that we're justifying the performance in any way. This definitely did perform below our expectation of what we had, and we went in and we learned a lot of lessons and had to recalibrate our approach for the Delhi market. Having learned that and understanding what we need to do going forward, that will be more on optimizing the infrastructure that we have, looking at some capacity addition, some reconfiguration of the clinicians, looking at departments that do well, that fit well with things that perform well to our strengths. But yes, it's definitely something that we are far behind what someone who's, so let's say compared to all the other hospitals that are there, there's a lot more that we could have done. We were not able to do. One of the particular things, Gurugram, was we started this. The most important attraction, even though it's not on the main road, the most important attraction to us was that it would have been the closest JCI hospital to the Delhi International Airport. And it started, and 1 year later we had COVID. So the international traffic went to a halt, and even before that, given the market for referral kickbacks was quite atrocious, so we decided to get out of that business and rebuild the whole thing with a more domestic focus. So that meant whatever it was built for, the offering, which we've learned from, and now that we're past the hump and both the units are doing specifically, we'll keep expanding it based on the cash flow that you generate and be able to take it to a more sustainable.
This is very useful. Thank you for that detailed explanation. While you were explaining the SRCC loss, if I understand correctly, in the Western cluster, apart from the SRCC, there will be the Ahmedabad asset. So if I adjust for the SRCC loss, the Ahmedabad asset also doesn't seem to be making, a mature kind of a profitability. So like you explained for Gurgaon, if you can also explain, like, if I understand correctly, is that right understanding? And what is the reason for Ahmedabad also being?
Ahmedabad also, we came in with one set of assumptions. Ahmedabad shares a lot of the similar dynamics as Mumbai in that most of consultants don't get themselves empaneled in one hospital. They are visiting consultants and they take a high percentage of the. So we came in, we didn't want to adopt that model on the bus. We got consultants from outside who would work with us on a full-time empanelment. Only to learn later on that one of the worst things you can do for a very, for a market like Ahmedabad is to bring outsiders. Anyway, it was too late by then. We had the team, so we built it up. The other was that coming in from outside, we had no idea about the particular dynamics of the Ahmedabad market. There is a river that separates two parts of the city, and we, coming as outsiders, had no idea of the intercommunal dynamics that exist between those two, and chose the one that we thought was a lot more densely populated and gave us a much larger land parcel and was more central, but turned out to be not a place where people want, at least people with money, want to go. So it still does well. It attracts a large number of patients, but it's heavily dependent on poorer patients who are under government scheme. Now, the government scheme pays on time. It doesn't pay well. And to the extent that they keep paying, we're able to keep the show going, but we have to take that hospital up to that next level. So it's reached that break-even level. It's got a decent number base, and now we can just build on that. We are adding oncology over there, so that will change the mix of departments a little bit. We'll be adding a couple more beds that are a little more high-end private rooms, semi-private rooms, and it will gradually build up from there. But there again, lessons learned on location, as well as coming in with the wrong consultant engagement mix. And again, we're past that, and now we can just add to our strengths, but it won't deliver outsized returns to the kind that we had expected. And so that's why even in terms of the CapEx spend, the bulk of it we'll be spending on the hospitals that demonstrate the strongest numbers and the strongest potential for growth.